Welcome back to the 4F podcast. Today we're going to be talking about how business credit works. So, first of all, with business credit, whenever you first get started, it's mostly based off of your personal credit score. So, if you have a 680 and above for your personal credit score, that's whenever you can usually personal guarantee business credit. And a personal guarantee is where you make yourself liable for the business debt, so that way, that gives the bank a lot more confidence when lending you. After about 2 years and you get some positive payment history under your belt, then you can start getting business loans. You usually need 2 years of tax returns for that. Business credit, after that point, starts to become separated from your personal credit because you develop your own track record for your business. SBA business loans are the best because they give more funding and they usually have lower interest rates. You also can do a business line of credit. If you secure your loan with property or with a solid tangible asset, that's also another way to get a lower interest rate as well. Business credit cards, Chase has the best business credit cards in my opinion. They have really good rewards. They have excellent bonuses. They have really good products. Chase does. But yeah, quick video. Just wanted to talk about how business credit worked. A couple more points that I remembered. You want to make sure that you have a business phone number and you want to have your own website. These are things that businesses will look at, lenders, whenever they're deciding to give you a business loan. Business Credit Suite is a really good resource. Go on there. They have a lot of good free information where you can learn the amount of risk that your business has for that industry will also determine the amount of funding you'll get, the interest rate, if the lender will consider you risky or not. For example, something like an ATM business or anything to do with crypto or anything like that is going to be considered more high risk versus if you have like a plumbing business, something that is more solid, more steady. You're going to be able to get a lot more funding generally starting off like that. One thing I see a lot of people do is they do a construction loan and construction loan. They do a consulting company, and then that allows them to own other riskier businesses. But you just get the loan for the management consulting company and hold it as a parent company. Um, and then if they ask what you're using it for, then of course you tell them that. But a lot of the times for things like business vehicles and things like that, you can get the business vehicle for the holding parent company, and then you can still use it for your other company as long as it's a single member LLC. So yeah, consulting companies, general management companies, those can get a lot more funding than the more higher risk businesses. So that's just another way to, lower your interest rate, get higher approval odds, and whenever you're first getting started out, really get funding at a quicker rate. Next video, I'm going to be talking about how construction loans work. We're going through one right now, so I'm just going to share some of the information that I learned. I'm going to break this up into a second episode, so I'm going to go ahead and start doing that one next.